Well, hello, traders and investors. Today is August 12th. It's a Wednesday. It's a hump day. Got a lot to talk about it. What do I always say? Let's get into it right now. World stock market turned higher on Wednesday, although sentiment appears to be very, very fragile due to lack of progress with U.S. talks about economic aid. It looks like two parties are completely at a standoff. Britain imposed restrictions on business and public life later than most countries, which means they're going to see figures impacted for June show a rebound, which is already happening, which may encourage some investors. Concerns over fresh wave of COVID-19 infections is gaining traction with a resurgence of cases in Germany and Europe. Germany has been lauded for keeping the pandemic under control for a long time, but the easing of measures and the return of travelers in recent weeks has led to an uptick in infections. It just seems like no matter what we're doing, till there's a vaccine, an effective vaccine, or a potential cure for this COVID-19, I'm not a doctor, I don't know all the details, but it doesn't seem like things are coming back. It just seems like no matter what happens, we take one step forward and two steps back. Talking about local news here in the States, discouraging lack of progress in talks between Congress and the White House over more economic aid for the U.S. economy has dogged trading this week. The S&P is literally within 2% of all-time highs set in February, stunning turnaround for nearly 34% tumble in March when COVID-19 pandemic sent stocks down. Stocks are attractive compared to other assets. Why? Because Federal Reserve is pumping up prices and putting money into the stock market via central bank to stabilize the market and cutting interest rates at the same time and ramping up bond purchases. Hopes are rising that many pharmaceutical companies are working on ways to treat COVID-19, will deliver a vaccine in the coming months. Russia reported yesterday, I don't know the validity of that, but they reported they have something. Moderna came out with news that they're making a deal with President Trump. There's something going on. Gold is still above 2,000 per ounce. That's the benchmark. Actually, 1,800 was the breakout point. And crude oil is still above $40 an ounce. Now, I want to show you that I'm looking at something important right now. It's actually a 90-10 setup. Now, I showed you 90-10 setups before. A 90-10 setup occurs when the asset I'm looking at makes a 90-day high and then breaks and makes a 10-day low. 90-day high, 10-day low, but there's a caveat. The day that the asset makes the 10-day low, it has to close at the top 20th percentile. And by the way, we trade this to the short side too. In other words, asset makes a 90-day low and then makes a 10-day high instead of a 10-day low, and then it closes at the bottom 10% of its range. Let me see if I could show you an example, actually. There's nothing. Oh, yeah, there is something today. Here we go. TMV. Well, it's actually the opposite of this. Here, let me show you what I mean. So take a look at this. This is a complete opposite of what we're looking at. We make a 90-day low, then we make a 10-day high right here. That's the highest price in 10 days. And then we move and close near the bottom of the trading range. So in this case, we're looking at a 90-10 high. What we were just looking at was a 90-10 low. So again, we make a 90-day high, we break down, make a 10-day low, the lowest low of the last 10 days, highest high of the last 90 days. You may have to watch this one or two times to get a review. And then we close near the upper end of the range. And look at this, right below the 50-day, right above the 50-day moving average, which is a really good support for the bonds. And if you go further, you'll see the bonds are trying to break out. And if they take out the recent swing high, we're on to unprecedented times that we've only seen during COVID-19 pandemic breakout right here, when the market was breaking, when the stock market was really breaking below the 200-day moving average. Remember, there's an inverse relationship between the bond market and the stock market. When stocks really fall hard, bonds spike. We made over 429% return on this trade, by the way. I remember it like it was yesterday. 429% on this trade right here. Anyhow, let's go back to the present case. So I'm looking to buy. I'm looking to go long right here. And I would place a buy stop right at the 167.70 level. All right? 167.70 level on a stop. And if we break the 50-day moving average, which is at the 165 level, forget about it. So we go long right above the swing high. The swing high was at the 167.49 level. So we would go right above like 167.70, 167.65, 167.80, just above this level, and we would put a buy stop. And then we would liquidate it right here at the 165 level, 165.29 level. Now, if you're trading options, I'll give you the option too, don't worry. We don't want to go 3 days expiration. We probably want to go 38. 38's not really that great. Let's go 66. That's perfect, actually. I like to pick between 60 and 80 days. That way, here's the thing. I never hold an option if it has less than 30 days to go, because the curve, the expiration, the decay curve goes really, really steep. It goes from like this to like this to like this. The last 30 days, it's very steep. So I'd like to buy this option, and I'll hold it if the buy stop gets hit. Within the next few days, I'll buy this option, and I'll hold it for 10, 20 days. And if it doesn't do anything, if the stock or the asset, it's a bond, ETF, if it doesn't do anything, we'll just liquidate it. So again, we'll hold it for a few days and for a few weeks if it gets hit. Now, it's 167 right now. I would be look at liquidity, open interest, and open interest very high, volume is very high. You're not going to have any problems here with the fill, and the options are pretty cheap, actually. 167, probably go to the 170. It's probably going to be a little more expensive. You're probably going to end up paying about 350 because we're moving at the price moving higher. But anyhow, 170 strike price looks really good. I wouldn't go 165 because it's too in the money. I'd go with the 170. It'll give you a good bang for the buck. It also has good open interest. Don't go higher. Don't go 175 or 180 because the delta is going to be too low. Delta is the dollar exposure in the option versus the stock. So if the delta is 0.20, you're going to get 20 cents for every dollar the stock moves, at least in the beginning. So I would go with either the 165, which will probably cost around 650 at that point, or I'd go with I would more than likely go with the 170. That's going to go for about 350 at that point. And if the trade doesn't work out the next few days, forget about it. Literally, forget about it. We want to see this buy stop get hit literally in the next day or two. Sorry about that. Now, while I'm looking at this, I want to take a look at something else with you. This right here is a triple leveraged bond. So if you want to get some more upside leverage, you could trade this here. And if you want that leverage, the buy stop would be around the 43.50 level, and the sell stop would be around the 41.70 level. The 50-day, if it breaks the 50-day moving average to the downside, I don't want it anymore. I'm pretty strict. So entry buy stop at 43.50, sell stop at 41.40. And again, if you're trading options, and this is triple leveraged, you're going to get 3 times the exposure that you would get from the other one. Again, we would go for the monthly here. It's a little too much time. How about, that's not enough time. Let's see. There we go. That's okay. And again, the price is $43. You would go probably with you can go with the 45. You can go with the 45, and you'll end up paying about $4.50. Remember, we're looking at a buy stop, so we're looking for price to go a little bit higher before we go in. And again, I like the bond market because I'll explain to you why. This is important. I want to show you why. Look at the price of the S&P 500. Let me show you a chart. Notice price action's been moving higher. Let me just delete all this stuff here. So I want to show you this. And there's no way around this. There really isn't a way around this. Lower highs, higher highs. Price is getting higher, momentum levels are going lower. That's a rubber band that's winding up. And I know what you're thinking. Well, Roger, it's been a while. But see, here's the thing. The more it winds up, the harder the fall. It happened right here. And look at the fall we had. Let me show you how long the divergence lasted here. Look at that. Oops. Look at that. Lower highs, price goes higher, we break down. Momentum levels are declining, lower highs, price is going higher. That's called narrowing of momentum. And that's not the only reason why I think the stock market's going to cool off a little bit. Gold is rising, commodities are starting to rise, Transports, which is a defensive sector, is rising. And most importantly, let me show you momentum, momentum, momentum. There's just only so much we can do. There's only so much. We're now going up for the second top, but we never went below 64%. Every time we go above this line, and this is a monthly chart, every time we go above the monthly chart, we need to cool off and go to at least 50, 40, 30 level. We're still stuck between 94 and 64 percentile. This market needs to cool off. And that's one of the reasons why you're seeing divergence between the RSI oscillator and price, because momentum is overbought. Markets are stretched out. In February, that rubber band contracted, and then it stretched out again, and now it's doing this. And it's going to only do this for so long. It's going to pull, pull, pull. And if it can't pull further, it only has so much elasticity, right? And then it'll just snap back. And that's what I'm afraid is going to happen. Look, we went high here. We went a little lower, but then we went here, and then we broke down. So I'm waiting for this level to break again. And I'm not seeing a major crash or anything like that, but I am seeing some weakness in the stock market, and that means it may be a ripe time to get into the bond market, all right? At least for the short term. Gold, bonds, they're defensive assets, and if you are insistent in staying in stocks, move away from individual stocks and move into ETFs. They'll give you more diversification, which means less volatility and less exposure. Folks, chances are you're missing out the number one easiest ways to profit from stocks in 2020. Have you heard of the rise of Robinhood, the no-fee investment app? The one you could have made 556% in 6 days on Hertz? And it's a zombie stock. Have you seen the chart on Hertz? I mean, it had no bounce. Or how about Marathon Oil, where you could have earned 165% literally in a few weeks? Folks, Wall Street's not paying attention to any of these names. They completely missed out. Now, everyone wants to know where will this Robinhood effect strike next? I've got answers for you. Do you want to know where this Robinhood effect will strike next? I'll tell you. You can find out. Find out the next big winner by clicking the link below. Again, Robinhood is an app. Traders on that app have been making massive, massive gains very, very quickly. There's a way for you to profit from it. 556% on Hertz, 165% on Marathon Oil. We've had huge profits on Tesla, Intuit, and many, many other trades. And it's completely under the radar of Wall Street. Wall Street is completely clueless to this. I mean, clueless. Find out the next big winner. Click the link below. Bye, guys. Talk to you soon and have a great day.